I'm Charlotte McLeod with the Investing News Network, and here today with me is Brien Lundin, editor of Gold Newsletter. Nice to see you. Thank you so much for being here in person at PDAC.
Yeah, great to be here again, Charlotte.
Really good. So we're here on the very first day. This is the first interview of the morning, so we don't know how it feels yet. But we're coming off of February that I believe I read was the worst month for gold since something like June 2021.
Yeah.
So I want to start by getting your take on what happened to gold this past month.
Yeah, it went down. I was speaking at one of the Vancouver shows in late January, a little over a month ago, and I was very bullish in gold. With the price had gone up about $320 since early November. We were in a bull market mode, and I was trying to stress that to people, and then I give a presentation, we're giving presentations here now, and all of the charts are flipped. Whereas gold was going up, now we've had that bad month of February. And I think the theme that we had going into the year, one, that the Fed was nearing the end of its rate hike crusade, as it were, and maybe had one or two more hikes left in it, maybe quarter-point hikes, before it would sit back and see what the lagging effects would be. I think that thesis is still in play. I think it may have been delayed a month or two. I don't think we're going well into the summer with continuous rate hikes and a Fed funds rate at 5-6%. I just don't think we can do that for a number of reasons. And I think it's just been delayed a bit. I think the Fed is ready to pause at some point and see what happens.
Right, and when we talk about this worst month since June 2021, we do probably have to put that in context. I believe it was about a 5% decline in the price, and probably as we did when we look back at 2022, we have to remember how is gold doing in comparison to everything else.
Yeah, and gold has done fairly well compared to other asset classes. What's interesting to me is that gold has been outperforming the stock market really since the beginning of the year, really going back through the fall. So that's good because in an environment like we've been in really since COVID started, where all of the investing asset classes have been driven by central bank liquidity. So everything floats up on that sea of liquidity together. There hasn't been much in the way of decoupling where gold has been able to move independently. The few episodes we have had been when stocks were going up and gold was going down. However, over the fall and going into the new year, we've seen some periods where gold has actually gone up while stocks have been sideways to down. So that's an important decoupling because I think going into the future, we're going to be in a scenario where it's not quite as bullish for other asset classes like stocks and bonds as it will be for gold, because I don't think the Fed will be able to get inflation down or very close to its 2% target.
Yes, and I definitely wanted to check in with you on the Fed and inflation because we're now, as we speak, about a year since it first started hiking. So how have we done, and what do you think the path forward is for the Fed in 2023? Yeah,
I think they have to pause at some point. There are a number of factors that are out there. Number one, or one of the factors out there is the fact that the markets, especially the bond market, today's bond market was built for near zero interest rates. And when you raise rates so quickly, so rapidly and to such a degree, things tend to break. And we haven't seen that yet. We haven't seen the kind of a Lehman moment in this cycle. And it's something it will break eventually out there. And I think the Fed will have to respond as it has always responded, by returning to an easier money policy. The other thing is the interest costs in the federal debt. The latest figures show that it's currently at about $852 billion a year. That's from the Fed itself. And yet we have not rolled over enough of those maturities. We have not adjusted to the latest rate hikes, so it's going higher. And it's going through $1 trillion a year very quickly. If we were getting to what some people are predicting, like Fed funds rate in the 5 to 6% range by mid-year, we would be paying between $1.5 to nearly $2 trillion just in interest costs in the federal debt. So you would be doubling or nearly tripling the deficit every year with just the interest costs. And I just don't think that's fiscally or even politically possible.
Right, and just going back to that 2% target that you're mentioning, okay, we're not going to get there.
Yeah.
So what is the likelihood that the Fed at some point says, okay, we're going to revise that upward?
I think that it will have to face the fact at some point that it can't get that rate down there. That's an interesting point. You can watch some shifts in Fed rhetoric. I think it's a very good chance they're going to have to explain themselves away because they won't get there. And importantly, when they pause or even pivot without beating inflation, without getting it down to that 2% level, that's really an admission that they're impotent to fight inflation. And again, I think that's a very bullish environment for gold, silver, the metals markets, commodities, tangible assets in general. But importantly, it's not as bullish for stocks and bonds because you still have that hurdle level, the hurdle rate of inflation before you make real money. So stocks and bonds would have to go up 4 to 5% before they're really advancing at all. Whereas a more inflationary environment like that would really benefit gold and silver.
Right, and we often hear an environment for gold and silver may not be so good for other aspects. So you mentioned stocks probably not good for them, but just on, I think, a personal level for people, if we accept an environment of higher inflation, that sounds like it has not very good implications for your average person out there.
Yeah, it doesn't have good implications for the broader investment markets. That will be countered to some degree by a Fed that will have returned to, if not a dovish posture, at least it's not pummeling the markets of rate hikes. So I think even a pause will be bullish for asset classes across the board, a real jolt of adrenaline for the markets. That said, if they pause and have not really deterred inflation or not gotten it close to their target levels, you'll see some small shift of allocations, global allocations, toward the metals and toward commodities. And just a small shift from those huge markets, the bond market, equity markets globally, small shift of those allocations into the much, much smaller markets of gold and silver could have really explosive consequences in terms of prices and valuations.
I remember we spoke about that when we talked back in October of last year, how a pause would really ignite the precious metals space. So I was going to check in with you and ask, is that the main thing that we're waiting for right now if we want to see gold and silver prices go higher?
Yeah, I think the main thing we're looking for is Fed policy, Fed rhetoric. I think we're going to have, I believe March 22nd is the next Fed meeting, and I think we're going to see another quarter-point hike there. The speculation at that point will begin to run rampant about what's next, and that is really what we need to look at. Everything is driven by how the markets interpret Fed rhetoric, Fed policy, what they think the next move is going to be. So even economic data is interpreted in that context. So high inflation numbers have been bearish for gold, strangely enough, because it indicates the Fed will be more hawkish. And that's been the case for years now. So the world, it is a topsy-turvy world, and everything is driven by Fed policy. So that's really what anyone needs to look at.
Okay, and another thing I want to check in with you, because you talked about the cost of servicing U.S. debt, which is going higher and higher as interest rates rise. Can you put into context the debt ceiling, because we have all these debt ceiling conversations going on. We know that it's pretty much going to have to raise, otherwise they default. So what are your thoughts?
Yeah, that's it. They're going to have to raise the debt ceiling. They're going to make political hay out of it. And I think it's a non-factor. I think the markets really see through that, see it as political brinksmanship, and without any real lasting effects in the market. So it really is just a sideshow to me.
Yeah, and I want to also go into that idea you brought up of cracks emerging in the system, which is another thing that you mentioned back in our last conversation. And specifically, you pointed to derivative exposure from the bank. So I think that might be a little bit of a complex topic for people to understand. So can you go into that a little bit and explain?
Yeah, it's interesting. Nobody really understands it, and I think that's the issue. Even the investment banks that hold these derivatives don't understand it and don't have a good idea of what their ultimate exposure is. I actually had a conversation on this with Alan Greenspan a few years back when he spoke at my conference, and I was talking to him about the problem of the growing federal debt. Of course, it's doubled and more than doubled since then. But he said what really concerned him was the derivative exposure, because post the 2008 great financial crisis, all of those too big to fail institutions are now backed by Uncle Sam, backed by us. And so their derivative exposure, which is not measured with the T in trillions, but with the Q in quadrillions, that's how big it is. That derivative exposure is ultimately going to be borne by the U.S. government and the U.S. financial system. So if you have cracks in that system, if you have one of those dominoes fall and it quickly spreads, then you are going to see liquidity injection, the kind of easy money policies that would dwarf what we saw post-COVID, which in turn dwarfed what we saw after the great financial crisis. So that's the cycle that we're in, an ever-accelerating cycle where the markets are addicted not so much to easy money, but to ever easier money. So with every recurring crisis, which is going to happen, we don't know what it is, we know there's going to be another one. With every recurring crisis, the central banks have to respond with even greater force than they did before. More of the monetary adrenaline, more of the monetary drug, because the addict, the markets, have grown tolerant of the drug. So to get the same effect, you have to do that much more. That's a long way of saying that something's coming down the road, and if you thought everything we've seen so far is crazy, just wait.
Okay, a little bit alarming, but definitely we can see why we might want to have
Great
gold.
way to start off PDAC,
yeah,
right?
amazing. Speaking of what's going on with the central banks, right? Another big theme. So they have this crisis potentially building. Central banks have also been buying a lot of gold lately.
Yeah.
So does this relate in your mind?
Yeah, the question to me is whether that's a policy, a strategy, or whether it's just a feeling that fiat currencies in general are losing their credibility with every one of these cycles. So gold does not, and it is an anchor for those portfolios. I think it is a recognition from the central banks, whether they admit it publicly, whether they admit it in their meetings, whether they admit it to themselves, that at some point there has to be a reset of this global fiat currency system. If you go through these cycles one after another, just getting more extreme and solving every problem with just avalanches of liquidity, these currencies begin to lose credibility with every one of these cycles. At some point, the only way that they can regain credibility is to reattach themselves to something that's, well, the obvious choice is gold. For a number of reasons, all the reasons why it's been that anchor for thousands of years. So at some point, that readjustment, that great reset is going to happen, whether it's this cycle or the one after that or even the one after that. And in that case, the central banks want to have gold.
So it's very do as they're doing, not necessarily as they're out there saying.
Yes, exactly.
Okay, so we know that all these circumstances are lining up and they're bullish for gold. Mm-hmm. Do you have a price range in mind for this year? I know that's a tough question, but let's try.
Yeah, I don't like the price predictions with time frames, but that said, I think this is going to be a good year for gold, maybe more so in the back half of the year. But if you look at what gold could do, it could go up, say, 20% this year. That would equate to a price of about $2,300. So I'm thinking we're going to break the record this year, and I'm thinking we're going to get into the $2,100 to $2,300 range. But knock on wood,
well,
it's hard to separate hopes from analysis. But I think this could be a really good year for gold, and more importantly, I think for investors, it's going to be a good 3 to 5 years going forward. A lot of crazy stuff is going to be happening over the next few years, and gold, I think, will be seen as the stalwart, the bulwark of safety, the safe haven through all of that. And I think it's going to be good to be in gold and silver and the mining stocks during that period.
All right, so it does feel like it could happen, and let's talk about silver as well. Important to go there as well. So I remember that you've told us before, the industrial side, you can kind of forget about that. It's the investment side of silver that really matters. Yeah. So in terms of investment demand for silver in 2023, What are you looking for there in terms of the physical buying as well as the ETF side? How's that shaping up?
Yeah, I think we're going to have more physical buying and importantly, the right kind of physical buying for silver. You know, if I tell people all the time, if you want to buy the ETFs or the ETPs, you don't want to buy SLV, you want to buy PSLV because you have a great confidence they're actually buying the metal. In the silver market, we frequently have these cycles where all of the retail product is wiped out. And that's more a function of the fact that national mints aren't good business people than anything else. And they don't have good inventory control, and there's only so much product available at any point in time, so that gets wiped out. What's more important is the 1,000 to 10,000 ounce bar level than the more institutional level of physical demand. And that's where these ETFs come in. That's where something like the Sprott Physical Bullion Trusts come in. And when we have that shift in allocations toward the metals, you'll see big funds moving in, and they're not going to buy 1 ounce bullion coins or bars from the local coin dealer. They're going to go through these big trusts and ETFs, and that's where we're going to see the right kind of demand that will actually move the markets.
Okay, I think that's a good distinction to make for everybody. So with all of that said, we've gone through what's going in the markets, what's happening in gold and silver to some extent. Can you give a sense of what you're doing with your money right now?
Well, I'm not doing anything with my money right now because I went and bought everything I could find over the last month.
So it was time to buy.
I am fully invested in the sector in mining stocks. I have little liquidity left, and if I buy something else, I'm going to have to sell something else at this point. So I am all in on it because I think, and really since midsummer, the market in general, these junior mining stocks have been at really attractive buying levels. You know, you should never assume that you can pick the exact bottom, but you know, it's been good enough for the last 6 months, 7 months, 8 months. And there are still some opportunities out there. There are some companies that are just valued at ridiculously low levels given the assets or the prospects that they have. So we've been covering those in Gold Newsletter and coming out with some new exciting recommendations. I've been putting my money to work. So I've already done it. And now I'm waiting for it now.
Okay, and maybe you could give some context. Like, at what point did you reach the point where you're like, okay, this is set up? When did you amass all of these positions?
Yeah, I kind of recognized and was buying here and there around midsummer, and really made some moves September, October, because I saw some valuations of companies. In that case, some companies that had actual resources in the ground that were at long-term lows. Over the last month or so, there were some companies that just more based on their individual prospects that I thought they were really exciting opportunities. Not so much a broader market view, but this company is extremely undervalued and has some catalyst coming up, and this one as well. And the key factor is that you can find these things in this market. This junior mining share market, and you know that casino that's a few doors away from us right now. It really is something that is inefficient. So if you take the time, the trouble, dedicate a little money to subscribe to the right newsletters, go to the right conferences, talk to these people, do your research, you can outwork other people and you can take advantage of these inefficiencies. You can find these bargains out there and you can outperform, sometimes spectacularly.
So this is good news for anybody who is here or who's sitting at home watching and still wanting to get into the sector.
Yeah.
I was going to ask if you had any advice for investors. It sounds like you've given it. So are there any final words that you would leave the audience with on investing, on 2023, on the precious metals markets?
Yeah, I think this is a crucial point. The window's still open for these junior mining stocks. I think they need to do their research. Obviously analyze the personal situation. the recommendations that I and other newsletter writers put out there, we don't know the individual circumstances, so we can't give specific investment advice. But in the context of your goals, your risk tolerance, et cetera, look at these companies because they run the whole spectrum of risk and potential reward. Find what you're comfortable with, do the research, watch INN, read INN, and this is the time. This is the time. The next couple of months, the next few months, I think, is when the window will still be open, but it's going to close pretty quickly after that, I think.
Okay, I think that's a great note to end on. Thank you so much for coming by, for being my first interview at PDAC. It was great to have you.
Glad to get you warmed up for this zoo about to descend on us here.
I think it's going to be fun. So once again, I'm Charlotte McLeod with the Investing News Network, and this is Brien Lundin with Gold Newsletter.